Hi, I'm Amy Ford, and in this video, we're going to cover financial statement analysis, as well as earnings per share, EPS. How do accountants and financial professionals analyze financial statements? This analysis involves the comparison of one company against another, or it could be comparing this year and last year for the same company. The most common method used to do this financial statement analysis is through ratio analysis. We will be learning how to calculate ratios in each of these areas, which are commonly tested on both the CPA and CMA exams. Liquidity measures a firm's ability to pay its current obligations as they come due and remain in business in the short run. Activity is a measure of how quickly major non-cash assets are converted to cash. Solvency is a firm's ability to pay its non-current obligations as they come due and remain in business in the long run. And lastly, we will cover profitability ratios, which measure how effectively the firm is using its resource base to generate a return. We're going to begin with liquidity. Liquidity measures a firm's ability to pay its current obligations as they come due and remain in business in the short run. This means that we will utilize those current items on the balance sheet to calculate these items in our liquidity ratio analysis. Just remembering to use current items for these liquidity measures could help you get the correct answer on a multiple choice question. One basic liquidity ratio is the current ratio. To calculate, you divide the current assets by the current liabilities. The result is a ratio that measures the relationship between current assets and current liabilities. A firm must have enough current assets to meet upcoming obligations. A low current ratio indicates a short-term liquidity issue, where the firm may not be able to pay the bills, so to speak, in the short term. On the other hand, if the current ratio is excessively high, that could indicate that management is not investing idle assets productively. Net working capital is the difference between current assets and current liabilities. This figure reports the resources the company would have to continue operating in the short run if it had to pay off all of its current liabilities at once. The quick ratio, which is also commonly called the acid test ratio, is similar to the current ratio. The quick ratio, though, only includes the quick assets in the numerator: cash, marketable securities, and net receivables. Other items that would be current assets, like inventory and prepaid expenses, are excluded from the calculation of the quick ratio. This quick ratio is a more conservative measure than the basic current ratio. Here's an example of a calculation question for the current ratio. This information says that Dominic's company's year-end financial statements, they give us the current assets, the current liabilities, the equity, the net sales, the cost of goods sold, and the operating income. What is the current ratio at December 31st, year 2? The key is that the problem gives you lots of data, and you need to be able to pick out the important pieces to answer the question. The only data you need to calculate the current ratio for year 2 is the current assets and current liabilities. Now, once you realize that you can ignore all those other numbers, this isn't so hard anymore, is it? The current ratio formula is to divide the current assets of $4.2 million by the current liabilities of $1.8 million. The answer is 2.33. We would say the current ratio is 2.33 to 1. Isn't financial statement analysis an interesting topic? And now, have you learned from what we've covered so far? I hope so, and if you want to learn more, such as how to calculate solvency and profitability analysis ratios, as well as the always difficult earnings per share calculation, then click the link below or go to Gleim.com and look for our free basic accounting course in the CPA free resources section. In the course, you'll find great information on other topics, such as all the details on how to prepare financial statements and record transactions, which can really help you in your financial accounting classes. So click below or go to Gleim.com to learn more.